You know, when most of us think about life insurance, we picture a pretty basic safety net. But what if that net could do more? What if you could customize it to protect you from, well, all the other stuff life throws at you? Today, we're going to look at the powerful add-ons that can transform a standard policy, and we'll cover the essential tools that could literally save your business. Let's dive in. So let me just ask you this, right off the bat. Do you feel like your life insurance policy is really tailored to your life? Or is it kind of like a one-size-fits-all t-shirt? It technically fits, but it's not a perfect match. See, a lot of us just assume a standard policy is all we need, but we're about to challenge that whole idea. The secret to getting that perfect fit is something called a rider. It sounds technical, but it's not. A rider is just an add-on to your policy that gives you extra benefits. Honestly, the best way to think about it is like buying a car. You know, the base model gets you from A to B just fine, but you can add upgrades, a sunroof, heated seats, a better stereo to make it truly yours. Riders do exactly that for your insurance policy. Now, your standard life insurance policy is pretty straightforward, right? It pays out a benefit when you pass away. Simple. But what about those huge life events that can totally wreck a family's finances while you're still living? Things like a major illness or needing long-term care. Those can drain your savings in a heartbeat, and a basic policy isn't designed to help with that at all. And this is exactly where some of these riders become game changers. They provide what we call living benefits. It's a fantastic concept. It means you can actually access a part of your policy's death benefit while you're still alive, under certain conditions. This completely transforms your policy from a simple death benefit into a much more flexible and powerful financial tool for your life. Now, there are quite a few different types out there, but we're going to focus on 3 of the most common and, frankly, most important ones: the accelerated death benefit, the critical illness rider, and the long-term care rider. Okay, so first up is the accelerated death benefit rider. This one lets you get an advance on your death benefit if you're diagnosed with a terminal illness, and you can use those funds for absolutely anything, covering medical bills, paying for end-of-life care, or even just taking one last amazing trip with your family. It's all about providing financial peace of mind during an unbelievably tough time. Next up, we have the critical illness rider. Now, the key here is that this rider pays you a lump sum of cash if you're diagnosed with a specific major illness that's listed in the policy. Think a heart attack, a stroke, or a serious cancer diagnosis. That money can be a lifesaver for covering medical expenses your health insurance won't touch, or just replacing your income so you can actually focus on getting better. And the third one is the long-term care rider. This benefit kicks in if you get to a point where you're chronically ill and you can't perform some of those basic daily activities on your own, like eating or getting dressed. I mean, we all know how insanely expensive long-term care can be. This rider can be the one thing that stands between you keeping your life savings and watching them disappear. So, if you take one thing away from this, let it be this. These living benefits are all about protecting your family's financial future from the sky-high costs of a health crisis. It's about building a safety net that works not just for when you're gone, but also for the major challenges you could face while you're still here. Okay, so we've talked about protecting your family. Now, let's totally shift gears and talk about protecting your business. I want you to think for a second about your company's MVP. You know, that one person. Maybe it's a founder, a star salesperson, or that brilliant engineer. What would actually happen to your business financially if that person was suddenly gone? Well, the answer is something called key person insurance. It's a life or disability policy that the business buys on that absolutely crucial employee. And here's the brilliant part. The business itself owns the policy and gets the payout. It's not for the employee's family, it's a survival tool for the company. So what does that payout actually do? Well, it's a financial cushion. It gives the company the money it needs to recruit and train a replacement. It can offset lost profits while things are chaotic. And maybe most importantly, it sends a powerful message to investors, lenders, and your other employees that the business is stable and ready to move forward. Key person insurance is fantastic for dealing with that immediate financial shock. But what happens to the ownership structure of the business, especially if that key person was also a co-owner? You can't leave that to chance. You absolutely need a clear, pre-agreed plan for how ownership gets transferred. And that plan is called a buy-sell agreement. Just think of it like a prenup for business partners. Seriously, it's a legally binding contract that lays out all the rules ahead of time for how a departing owner's share of the business will be valued and then purchased by the other owners or by the company itself. As you can see here, there are a few different ways to set these up. In a cross-purchase, the owners themselves agree to buy each other out.
That's usually great for small partnerships with just a couple of owners. For an entity purchase, the business itself buys back the shares, which makes a lot more sense when you have a bunch of owners. And of course, there are even flexible options. The key is picking the one that fits your company's structure.
Now, to make sure there's cash available to fund these agreements, they're almost always backed by life insurance. And this slide really nails the crucial difference between the two main types. In a cross-purchase plan, each partner is buying a life insurance policy on every other partner. But in an entity purchase plan, the business buys one policy on each of the owners. It's a simple difference, but it makes a huge difference in how you manage the plan. So as we start to bring this all together, the big idea is pretty clear. Both your personal and your business insurance policies are not set it and forget it kinds of things. Real financial security comes from getting into the details, customizing your policies with riders for your personal risks, and creating solid legal agreements that protect the future of your business. Look, this isn't something you should try to figure out all on your own. Your best next step is to sit down with a financial professional who can help you spot the exact gaps in your personal and business safety nets. And that whole conversation can get started by asking some really simple questions. So I'll just leave you with this one question to think about. After everything we've talked about today, from living benefits for your family to succession plans for your business, what gaps might be hiding in your own financial safety net? Thanks for tuning in.